I'm Kezia Samuel with your quick take on the markets. U.S. stocks soared to record highs in the third quarter on renewed artificial intelligence enthusiasm. The quarter also added new winners as small company stocks joined the party. AI enthusiasm, though, was not just relegated to the U.S. alone. Emerging market equities also benefited as investors looked to China for other opportunities. Stocks in China rose 20% for the quarter and 42% for the year, making emerging market equities the best performing index. Across bonds, yields fell and prices rose, all as the Federal Reserve restarted interest rate cuts. Finally, across other asset classes, we can't leave without talking about gold, which is one of the best performing investments for the year as demand remains high from central banks. As a result, foreign central banks now own more gold than all of U.S. Treasuries since 1996. For investors, maybe the first 9 months of 2025 has been surprising because both stocks and bonds have generated positive returns despite non-stop uncertainties. Now, it is a good reminder that it pays to stay diversified and invested. During the quarter, investors also digested a much-anticipated interest rate cut from the Federal Reserve. Typically, when the Fed cuts, it's to avoid some type of a problem in the economy, and that recession is what they're trying to avoid. So as investors, should we be worried? History tells us that the Fed, though, has not had a good track record of cutting interest rates early enough to avoid that recession. However, this has not necessarily spelled doom for stock markets. For stocks, lower interest rates are generally positive as they allow businesses to access cheaper financing for growing their businesses. In fact, since 1970, we put this data together for you on what happens when the Fed starts to cut interest rates on a 1, 3, and 5-year basis, and were they successful in avoiding a recession or not. In the 1-year period, there are some time periods where it had double-digit declines in the stock markets. They all coincided with some type of an economic event. The inflation spiral of the 70s and 80s, the bursting of the dot-com bubble in 2000, and the great financial crisis of 2008. Now, but we span out. When you look at 3 years and 5 years, you see that we start to see more green. The instances of decline starts to reduce. In fact, on a 5-year basis, there's never been a time period with negative returns. Now, no surprise, stocks tend to do better when we avoid that recession, but surprisingly, the gap in performance is much smaller than one would anticipate even during a recession. Thank you for listening. Till next time, I'm Kezia Samuel.